welcome to another edition of Meet the Investor. Today, joining us is Michael Smith, partner and co-head of the Ares Credit Group at Ares Asset Management, one of the leading alternative asset managers in the world. Michael, thank you for joining us today.
Thanks for having me.
Can we start maybe by you telling us more about Ares as a business and then about yourself, your background, and your role?
Sure. Probably easier to start with my background because the past 25 years I've been in this business, and for the past 20 building the Ares platform. I graduated college from the University of Notre Dame, and like a lot of people in our business, went off to investment banking. I was a banker at Salomon Brothers for 2 years. And as I saw what was going on the leverage finance and capital markets side of the business at Salomon, I really wanted to get onto that side, onto the buy side, onto the structuring and deal side. I was a FIG banker at Salomon Brothers. I went back to business school, and when I came out of Kellogg, I joined a French bank where we were organized as a merchant bank within the larger, broader bank, and had access to different pockets of capital at the firm as both an originator of assets, so doing 1044As, high yield deals, but also underwriting loans, credit, evaluating companies, most often alongside private equity firms that were looking for capital to do buyouts. And this is late 90s. And also, I think, fortunately, at the French bank, I met three of my now best friends and colleagues, Michael Arrighetti, Kip DeVere, and Mitch Goldstein. The French bank eventually got bought by Credit Lyonnais via Credit Agricole. So this trend of bank mergers and banks exiting the leverage finance and asset management business was something we lived through. We took the team to the Royal Bank of Canada for 3 years, built up a middle market finance business, financing private equity sponsors. And eventually the bank, while they liked the asset class, given regulatory constraints that they had and given their desires to be an aggregator and a consolidator, Royal Bank did, I think, 30 or 40 acquisitions in that 3-year period. They very much wanted to look like JP Morgan. They wanted to look like a big bank that underwrote and distributed assets. And we wanted to be investors in those assets, due diligence on those companies, invest them on the balance sheet. And so we joined Ares, that same team that was together for 6 or 7 years at those two institutions, joined Ares, which at the time was a $4 billion asset manager, mostly in the liquid markets, focused on leverage loans, high yield bonds, and some distressed type assets. The team, which was already at Ares, had spun out of Drexel predominantly. Probably a common theme with people you're talking to in the asset management world. And so we joined and opened the New York office. We had, like I mentioned, we had about $4 billion of assets under management. This is now circa 2004. And really, Ares was reborn or reshaped at that time. We basically decided to call our business private credit and focus on raising capital to finance leveraged buyouts with a core competency of calling on private equity sponsors and financing their deals. And then we had the liquid credit business was there. Fast forward to today, the firm's grown quite a bit. Today, Ares' assets under management are about $420 billion. We are organized across many different asset classes, like the traditional alternative asset managers are, across credit, private equity, real assets, which would be real estate and infrastructure and secondaries. But credit is our largest group by far. That is now 3/4 of the assets, approaching $300 billion. And private credit, that business that we started in the US in 2004, now represents about $125 billion of assets, and is coupled with a European lending business in direct lending and a credit business in Asia, which makes about our direct lending and private credit business about half of the assets that we manage. And so I think Ares is known, obviously, as a great alternative asset manager, but credit is what we do. Even within private credit, we're still doing a lot of those core, distressed for control and, type of turnaround situations where fundamental credit analysis is important. And also, if you look at anything on the real asset side. We're obviously doing a lot of debt on those in the real estate world and in the infrastructure business.
So you've touched there on private credit, direct lending, and so on. Just in terms of the different type of lending that you do, could you just talk a little bit more about that? You mentioned lending to private equity effectively to help them make the purchases of the businesses that they buy, as well as lending to businesses and individuals. How does that compare to what a bank might do in terms of their lending?
Yeah, so it's funny because having been at the banks, there's very much and at least going back 20 years, there was very much a risk, appetite towards asset intensive businesses. Banks kind of were always saying, I want to lend to companies with assets that we could sell the assets and recover our loan. If they looked at it on an ABL basis, they were kind of, getting to very low leverage. As we spun out and started Ares, we were looking at a more service oriented, economy, and also a bunch of asset classes like financial services and software, and consumer, where you had high margin businesses that really needed cash flow loans. So we started kind of diverging away from those traditional assets that the bank was focused on, and into this more service economy. And I guess our core focus, if we had an investment philosophy or an investment culture that was kind of developed at the banks as we moved into Ares, was we have a chance to make an interest rate, and that interest rate could be 8 to 12%, depending on the company and the interest rate environment. So let's go try to find the best assets. And for us, that was kind of focusing on non-cyclical businesses or high free cash flow businesses, high margin businesses. And we started moving in that direction. Eventually, we continued to focus on those kind of new world companies. Also, our private equity clients very much focused on that. Where we saw the banks kind of go was keep continuing to push up market. So they were kind of, instead of kind of saying, hey, I'm going to focus on asset intensive businesses, I'm going to kind of move up market and focus more on fee generation through broadly syndicated deals, and the high yield market, again, which is an underwrite, distribute, make a fee type of model. And so there's been a lot more consolidation over the past 20 years, but there's also been a migration for the banks kind of up market to larger companies where they could underwrite risk and then distribute that to third parties, whether that's CLO managers, insurance companies, hedge funds, whoever's buying those types of assets. They very much moved into that because of the size and scale of their platforms and their desire to generate fee income. They moved that. So there's always been this void really in the middle market that we as direct lenders have been filling over the past 20 years. And really, with the real seminal moment was really the financial crisis, where not only had banks consolidated and started to move up market, but the regulatory capital restraints that were put on them for holding middle market type assets, non-investment grade assets really in general, was so penal, that the interest rate that they charged, the levered with the capital that they had to hold on their balance sheet, really made it uneconomic. And that's really was the catalyst for us at Ares and some other private lenders to really start building size and scale in our capital base and meeting that capital need for these middle market companies and then upper middle market companies eventually that buyout firms were purchasing.
So it sounds like there's a trend away from doing that type of lending anyway in banks, but post-financial crisis, the regulatory capital requirements made that even more difficult for banks to play in the tool, even if they wanted to. Does that imply that there's more risk in those type of loans given the regulatory capital constraints?
Yeah, I mean, absolutely. There's definitely a broad spectrum of risks and a broad spectrum of companies and types of companies and industries which you can lend to. And that's really kind of, digging into some of the secret sauce, whether that's Ares or others firms, is how we've come to evaluate that risk is by building size and scale in the team. So right now, just as from an Ares perspective, we have about 200 investment professionals that go out and source transactions. And so our goal is to try to see 2,000, 3,000 deals on an annual basis where we're getting information on different companies and different industries and different subsectors of industry. As I mentioned before, we're very focused on non-cyclical businesses. So to get from 2,000 deals to 500 deals where we want to do underwriting, we'll, focus on non-cyclical businesses. We'll focus on desirable sectors of healthcare, software, consumer, and whittle those deals down to 200 or 300 deals that we want to do and propose them. So who does those other 2,000 deals is kind of your question. And there's definitely a risk profile and a risk premium that you would get to fund less desirable, more risky companies. We have chosen to be very core and try to find the best of the best and finance with them and provide capital that's flexible and partnership oriented to them. As far as the banks go, a lot of them kind of focused on their region, their local companies, things like that. And they really didn't focus on those filters, where are these companies? What are the trends? What are the industries? And so there's so much diligence both on the industry, the subsector of the industry, and obviously financial diligence, and all the work diligence that we do on each individual company. Most transactions that we close, we're doing 3 to 9 months of diligence on the direct lending side, alongside the buyer, the private equity firm, sharing information, comparing notes, talking about them. And so, the answer is yes, of course. Did banks move out of that sector because there was risk involved and and it was there? Yeah, but we think it was because they didn't know how to source and evaluate that risk versus the fact that we're taking undue risk to make those loans.
Seems like almost that there's a bit too good to be true deals out there that people are picking up. Is that what makes Ares different in a sense? I understand you're spending all that time doing due diligence, but if it seems like the deal looks like it's fairly safe relatively and you're getting a high interest rate off the back of it, why isn't everyone picking up the same deal?
Well, maybe that's why private credit's in vogue right now and people are talking to it. But again, not all private lenders are created equal, right? So not everybody has the same capital base or the same resources to do that diligence. And so I think our biggest competitive advantage is marrying that team and that ability to do that with providing a full solution, right? So I mentioned earlier, we have over $100 billion dedicated just to our US direct lending. One of the key competitive advantages is our ability to go to a private equity sponsor and say, if you need a $200 million loan, we could make that and hold the whole thing. But if you need a $1 billion loan, we could also hold and arrange and do that whole deal. It's still only 1% of our assets. We're not taking undue risk on the platform. So there are certain things that do that. Also, that origination allows you to generate upfront fees. So a typical bank deal, the bank would charge the borrower 3 points, but pocket 2 points and then pass 1 point on to the investor. Since we're actually self-originating those assets because of the investment we've made in the team and the platform, we're actually taking the full 3 points up front and passing that on to our investors. That's kind of step one in generating alpha. And then we are partnership oriented and flexible. That work allows us to see what the private equity sponsor and the company sees as it relates to potentially growing through acquisition, potentially growing organically with the injection of capital or the improvement of products or the expansion of products that they're selling. And so we work with them on that vision and the flexible patient capital. When I say flexible, it might be instead of them getting, from a bank, a loan and a high yield bond, or getting a loan from a bank and having to go get institutional mezzanine or capital, Ares can provide one-stop solution in a unitranche and say, here's the debt that you need. We'll commit to the first 2 acquisitions that you've identified. So you have locked up capital to do some of the inorganic growth that you want to do. And then we understand that, over the course of the first few years, all the free cash flow is going to be reinvested back into the business to hire salespeople to do that. And we're willing to delever by growth, not through being paid back in cash. So that type of partnership orientation, customization of the product offerings, and the terms of the deals allow us then to get incremental spread above what a bank might do for a lower levered deal or an asset-based deal or something like that. So lots of different intricacies going on. And again, I think it's a wonderful asset class. I don't think it's too good to be true. I think we're charging a fair rate. It's just that people are willing to pay that premium to get that partnership orientation, that flexible capital. So it seems to be a nice two-way street between us and the buyout firms that then get them to use our capital, which could be, higher than they might be able to get, but pay for it. But to be able to effectuate the change and create value in their companies.
So what would that typically be in terms of a rate over a typical bank loan or cash rate? Or said another way, how much extra do you receive for the lending?
Yeah, on average, over the course of the past 20 years, if I look back through some of the charts that we have in our pretty presentations, that risk and that premium that we're taking is somewhere between 250 to 350 basis points, and pretty consistent over the course of time over either a risk-free rate or a broadly syndicated loan rate. I think what's unique about the market is that I do think it continues to grow. And I feel like we're getting into some of the real high quality, larger businesses now, just with some of the more, some of the more bank retrenchment that we've seen over the past year, some of the risk off behavior by the banks, potentially given what went on with Silicon Valley Bank and First Republic, more consolidation, more regulation, kind of another wave of 2008 and 2009, which I think will entrench private lenders in a lot more of these capital structures, and potentially for much bigger companies. We're already starting to see it. 5 years ago, we were pushing the limit to do $1 billion unitranche. We've raised some capital over the past 5 years, and there's a couple other scaled players that one or two direct lenders now together could probably easily provide a $3 billion unitranche. And you're talking now financing for a $500 million EBITDA business. Will the banks be there? Yes. Will the sponsors always pay that premium to us? No. But if they view that flexible capital structure as something that's very value added to that transaction, even in a good bank market, they might take that solution to partner with someone like Ares. And if the banks are risk off, then we might be their only solution. And so there's a nice complement there. And we still focus on the lower part of the middle market. So if that market's open, we push up and we get invested in those companies. But our regular way core all weather business is really more, smaller kind of sub $2 billion enterprise value companies where we're lending somewhere between $100 and $1 billion to those companies.
And so you've got a lot of experience in private credit and people investing in your fund and understanding where they might fit private credit in their portfolios alongside equities and, say, investment grade and government bonds. Where do you see private credit fitting into an investment portfolio?
Yeah, I would say as far as an Ares product, I would put you kind of in the alternative bucket, but way over towards the fixed income bucket, right? It's a great way to access, core corporate America, core fixed income. Most of our funds tend to pay dividends. Most of the interest that we collect is in cash. And we tend to, whether the company's structured as a dividend paying vehicle or it's a closed ended fund, we still tend to pay monthly or quarterly dividends or distributions on them. So it's a nice way to get some core income. In that you're in the alternative space, you are getting access to the private equity world, albeit, typically at 50% loan to value, in really high quality businesses backed by high quality sponsors. And so I think it's a nice adjunct to any type of core income type strategies that you're doing in the equity side or something like that, but you're squarely in the alternative bucket and very close to your fixed income side. So we think it's a nice product for a lot of people.
So with respect to the interest rate that you charge, or I guess what an investor would receive, do they tend to be fixed or floating rates?
Yeah, predominantly what we're doing across the platform, across most of our funds, is senior secured. So first lien senior secured. That might encompass a stretch senior or a unitranche, which might go a little bit deeper into the capital structure. And most of what we're doing is floating rate. So we're trying to match floating rate assets, typically with floating rate financing. If we are leveraging a fund, we tend not to lever funds more than 1-to-1. It's a nice way to kind of get a little extra yield in the portfolio for what we think doesn't put the funds or the vehicles in risk. And again, that's where the banks have now become some of our biggest strategic partners, putting leverage onto funds. But most of what we do is senior secured, floating rate, and if there's liabilities against that, it's floating rate liabilities.
So floating rate, as interest rates go up, the interest rate you're earning will also go up. with cash rates going forward, looking like they might be both in the US and Australia and everywhere around the world, peaking generally. Next move, probably over the medium to long term, is downwards. Does that imply there'll be a lack of returns going forward?
Yeah, good question. At least you didn't say golden age of private credit, because then I might have had to jump through the screen. We've heard that they're obviously all in rates right now are very high. But I'll say that all in rates are very high for the broadly syndicated market too, just because base rates are where they are. But yeah, so, I would say that we're very good at making loans between 8 and 12%. And again, it goes back to some of your earlier questions. That rate and spread and fees all depends on the quality and size of the business, and where you are, what types of companies you're investing in, and how you're getting access to those, whether you're getting all the fees and things like that. And so I feel very comfortable, today, putting assets to work. It's a great time. We're making 11.5%. Just on an ROA basis. And actually, the capital structures have deleveraged because of the interest rates. Companies are actually, their ability to take on leverage is less, just given the cash flow nature of the businesses. So we're actually seeing delevered capital structures by somewhere between a quarter and three quarters of a turn and high interest rates. I'm a believer in higher for longer, just because I think the Fed's already indicated that they're not going to be as aggressive this year as most would have thought. And we have an election in the back half of the year, which I think will temper Fed action. But, over the next couple of years, will base rates go, wander down 100 to 300 basis points and settle in somewhere down there? Of course. We've have a 20-year history at Ares in our direct lending business of generating kind of net returns, net low double-digit returns in all interest rate environments. And so we're, as rates come down, I don't think we're going back to zero. I think we learned maybe our lessons there a little bit.
So just extending a few of those thought bubbles, what makes you most excited about the asset class going forward, and what do investors need to be wary of when going to the asset class, into the asset class in the near future?
Yeah, and you and I sidebarred on this a little bit. There's a ton of different, names for direct lending, and a lot of different assets that are kind of thrown into the bucket. There are a lot of people that are saying I'm doing direct lending, but they're in the middle of the capital structure, which might look a little bit more like debt masqueraded as structured equity. Will you see a higher yield on that? Of course, right? You're going to probably see net 13, 14, 15% type of returns for that. And if you're getting that on a senior deal, then you're probably taking risk in the company or the sector or some type of cyclical risk in that business. And so just kind of understanding how your manager is originating those assets, what types of assets they're booking, what their focus is on from an industry perspective, who their partners are in those deals. If you're doing the deal with a private equity sponsor or without, and if the company needs more capital in the future for any reason, who's going to provide that? Sometimes lenders aren't good at doing that, and that's why they'll partner with the private equity firms. Sometimes they are, and that's an opportunity for them going forward. We're kind of a hybrid because we're large enough now that we're able to do that. But we like partnering with the private equity sponsors because we think they add a lot of value to the companies and help them grow. And so we kind of do a little bit of both, but are predominantly sponsor oriented. So, from my perspective, I love our position in the market. I'm highly focused on continuing to accentuate and, strengthen what I think are our core competitive advantages. So we continue to hire people to originate assets, to cover more of the market and see more deals. We continue to invest resources around portfolio management. So as we've gotten bigger, we have more portfolio companies that just need attention. And being, smart and aware about what's going on in your portfolio, getting, those monthly financial statements and digging into them and interpreting them and asking questions is great detection for any credit deterioration. And actually is, I think, one of the reasons that our default rate's been really low and our returns have been good is because of that real active portfolio management. But again, as we scale, we have to scale our team. And then continuing to raise assets, because I do think that, the size and scale of your capital base is important. So we can continue to bring different products to different channels. whether that's the institutional channel, whether that's the pension channel, whether that's the wealth management channel, et cetera. We continue to raise capital in all of those areas to diversify our capital bases, but also to build a war chest, because the more flexible capital solutions and the more capital we have to bring to the private equity community, the more that we're going to get that first or last call to finance a deal. And so I'm fairly bullish on the opportunity. I think our market is expanding. We're also getting deeper into healthcare. We're getting deeper into software. We're getting deeper into financial services. And we've also, one sector of direct lending, which we actually call alternative credit, where we're financing assets or cash flows. So this could be something like a NAV loan that people are talking a lot about. So evaluating a portfolio, understanding its NAV, and lending 20 cents on the dollars to that. We think that that's a really exciting place to play. We're also seeing portfolios of assets being sold from banks. So in particular, more the regional banks that are saying, hey, I have a portfolio of high quality X. It could be real estate. It could be consumer loans. We're either lending to that in our direct lending businesses or buying those portfolios in our alternative credit businesses. We think both of those are really nice asset classes to do. So we're expanding our fairway a little bit in some of our diversified credit funds. So I'm real bullish on just our pure play private credit. And in our diversified credit funds, I love some of the stuff we're doing across alternative credit and our core direct lending business.
Well, Michael, we're just up on time. Thank you very much for your insight into an increasingly popular asset class globally and with our investors here in Australia. And I look forward to speaking to you again soon.
Thanks for the time.